Peter Blair Henry has a brand new book out called Turnaround, Third World Lessons for First World Growth. He's here to talk about it. Welcome, Peter.
Thank you.
All right, in the book you talk a lot about discipline and the fact that the U.S. is losing it. Why is that? Have we become just too rich and lazy?
I think we've forgotten the lessons that we've taught, frankly, what used to be called the third world is now called emerging markets. For the last 3 decades, we've taught these countries about what it means to be disciplined, how to focus on the future. And frankly, we've forgotten those lessons. We need to relearn them.
And how far have, for example, China and Brazil come? How much discipline do they have now?
I think those countries have made really big strides. I'll give you a really good example. It used to be that we talked about fiscal discipline. And what does fiscal discipline really mean? It really means that during flush times, you save. It's like the ant and the grasshopper. During bad times, you've got something to draw down on. And emerging markets during the boom period from 2002 to 2007, roughly, they were running fiscal surpluses. So they were saving for a rainy day. We were running deficits. You'll probably remember in 2001, we had a $236 billion surplus. And we decided to give that back in tax cuts. Countries like Chile, for example, you mentioned Latin America. Chile had a huge surplus in 2008. There was a lot of popular pressure to spend that surplus. Finance ministers said, no, we're going to save that for a rainy day. In 2009, when the financial crisis hit, Chile was able to institute a $4 billion tax cut to stimulate their economy.
So
That's discipline.
So is it a zero-sum game, the fact that we're losing, they're winning, China is coming up, we're going down? Or can we all go up together?
We can all go up together. And that's the great thing about the global economy. I think people forget. And I think a great example of this is what I call the trade trap. So when we think about trade policy, most people think, gee, we've got to export in order to prosper. Send out a lot of exports, don't import much. It's sort of a mercantilist view of the world. No. Look at a country like South Korea. South Korea from 1965 to 1990 grew at over 7% per year, had a great turnaround. Grew at more than 3 times the rate that the U.S. has ever grown during its per capita GDP terms during its strong period after World War II. But that entire period, South Korea was running trade deficits. South Korea learned to export by importing first. So you need both imports and exports.
And now they're exporting a heck of a lot of Samsungs, even beating Apple.
Yep.
So how do you apply your turnaround principles to small emerging nations, third world nations like Barbados and Jamaica, which really were the centers of your study?
Yeah. So the big lesson is for small countries, the global economy is especially important because your local market is too small to produce the range of goods that you could produce if you're exporting to a global market. Again, you need to import in order to be able to do that. But a key lesson is if you're going to do that, you need to be competitive. And to be competitive, you need productive workers. And that means educating your workforce, and again, thinking about saving for a rainy day, investing in the long term.
Now, can the U.S. get its discipline back? We're looking right now at Europe, for example, and we're trying to see austerity be put in place in places like Greece and Spain, places where they, frankly, lost discipline. They're not doing so well over there. Can we get it back? Can we do better than them?
We can. I think the very important lesson we have to learn is discipline doesn't mean austerity. Discipline also doesn't mean just spending on anything. Discipline means, again, think about dieting. Austerity is like crash dieting. And pure stimulus is like, it's like sugary sodas. You need that path in between. And so what we need right now, particularly in Europe, is we need more reform and less austerity. So you mentioned Barbados earlier. Barbados in 1992 faced a very similar situation that the European countries are facing. An overvalued exchange rate. And the IMF told them to devalue it, and Barbados said no. In fact, what we need to do is we need to enhance productivity. And so they got the labor unions, the government, and the private sector together, and they worked out a bargain. That's the kind of compromise that we need to see.
You got to get everyone on board for a turnaround.
Absolutely.
Thanks for coming.
Thank you.
Thank you for watching The Street.